Good morning to everyone. I just want to give you a brief update of what we think about the current crisis that is spreading across the regional banks in America. So first of all, everything started, in my view, in 2019 when President Trump basically moved the threshold for being systemically important in America from 50 billion of total assets to 250 billion, basically creating the condition for the current crisis. Secondly, the regulator allowing it are partly to blame. Third, SVB was no ordinary bank, only had 20 branches and 200 billion of deposits, so 10 billion of deposit per branch. Consider that the average branch in the world has less than 10 million of deposits. So basically it was the bank of a billionaire and of the VC gurus. On top of it, Silicon Valley Bank exploded its balance sheet from 50 to 200 billion, so basically massive influx. Guess what? Exactly at the peak of the venture bubble and the crypto bubble. And as a result, as then this ecosystem started losing money, they had basically to withdraw money themselves. And last but not least, the big mistake they did is they took overnight deposit and invested in 10-year treasury, which is clearly something they never read the ABC of interest rates management. Now, cut a long story short, the Treasury and the Fed realized the mistake they did, and basically they provided a blank check guarantee on every deposit, insured or uninsured. I think this is very important to stem systemic risk. What are the implications medium term? First, I hope all these regional banks are going to get re-regulated as they are in Europe. In Europe, everyone above 10 billion euro has to follow through strict stress testing and basically fully comply with BIS and Basel rule. In the US, they will have no choice to do it. The market will force them. Secondly, we think that the capital liquidity buffer that are present in Europe will have to apply also to US regional banks. In Europe, even the smallest bank needs to issue TLAC and MREL debt, not in America. This means that many regionals will have to issue more expensive debt, there will be higher scrutiny, probably the earnings power will diminish, and certainly there will be further concentration. We don't expect this to become systemic because on the asset side, there is nothing wrong. In Lehman case, you had 2 trillion of AAA that were worth 30 cents in a dollar. This time, Treasury, and actually the Fed and the Treasury facility is buying Fed at par, not a mark-to-market. And they in a way tell you why this is not a Lehman event. In Europe, on the other side, liquidity has never been as high, the capital system is as strong as ever, NPL ratio all-time low, and banks have never been in a better position. From the equity perspective, regional banks were trading at 20 times earnings, European at 5, and now, post-share price reaction, regional banks in America are trading on 5 times earnings, so equal to European counterparts. So it's not an Armageddon. I think there has just been a repricing, and the market saw that these are no better than the European ones. But in Europe, they're taking market share, financial institution, they're safe, they're sound, and with interest rates that I think are eventually going to pause both in Europe and in America, because central bankers are realizing that the second order effect of their actions need to be understood in the context of time. And hence, here, I think the global macro implication is, in particular in the US, we'll see a deceleration in inflation because part of the tech engine is certainly going to slow going forward. Overall, the opportunity, as we do, to invest in the safest credit in Europe at 10 to 11% in dollar for the next 3 years, it's a basically unique opportunity. And de facto, we have zero exposure to any US regional, with less than 3% invested in America, the majority is in Citibank, JP Morgan, and Bank of America. So we feel that focusing as we do on globally systemically important financial institutions is what has allowed us over the last 70 years to navigate through every shocks. And we feel very comfortable in navigating these two. And we think it's the right time in the right names to deploy capital.